Welcome to the Minnesota State Retirement System Pre-Retirement Seminar. My name is David and I will be your narrator today. This section of the seminar is the Minnesota Deferred Compensation Plan. The Minnesota Deferred Compensation Plan is a voluntary savings plan to supplement your pension and Social Security income at retirement. It is available to all Minnesota public employees, and it is a state-sponsored 457 plan. That means it's similar to a 401k, but it's under the IRS code that applies to public employees. Any public employee in Minnesota, whether they work for a city, county, school district, or the state of Minnesota, may use this program. The one exception is employees of the University of Minnesota who participate in either a 457 plan or 403B plan through the University of Minnesota. There are 4 ways that the Minnesota Deferred Compensation Plan can help you fill a potential income gap. The first is maximizing your contributions. Save a little more each paycheck. Each time you get a raise, you can put part of that into the Minnesota Deferred Compensation Plan and be saving more for your own retirement. You can minimize the effects that the stock market volatility has on your investments through a couple of different strategies, and you can take advantage of the low fees in the Minnesota Deferred Compensation Plan. Maximizing your contributions means increasing the amount you contribute per paycheck as much as possible, but not to the point where you can't afford day-to-day expenses. The normal limit for anyone under age 50 is $19,500 into the plan per calendar year. The year in which you reach age 50, you may contribute up to $26,000 per calendar year. Keep in mind these amounts include any employer matching that you receive, and so you need to take that into account if you are trying to reach those maximum contribution limits. If you are eligible, you may be able to contribute up to $39,000 per calendar year. Please contact MSRS to see if you qualify. If you are eligible for a lump sum cash payout of your comp time, or if you're eligible for a lump sum cash payout of vacation or sick leave at separation of employment, those amounts can be deposited into your deferred compensation plan as long as the total for the year does not exceed the limits. Most state of Minnesota employees have their sick and vacation pay lump sums deposited into the healthcare savings plan per their union contract. We can see on this slide that increasing your contributions by $200 per paycheck can really add up in the long term. And the longer you're able to sustain this higher level of contributions, the more it's going to pay off in the long run. Contributing that extra $200 per paycheck could mean over $70,000 extra saved in retirement if you're able to do that in your last 10 years of employment. The practice of spreading money among different investments to help reduce risk is known as diversification. By picking a diverse group of investments, you may be able to limit your losses and reduce the fluctuations of investment returns without sacrificing too much potential gain. By investing in a mutual fund that may hold hundreds or thousands of stocks and or bonds, diversification is built into the fund. A diverse investment portfolio can offer less risk and can help you better weather the ups and downs of the financial markets. Diversification plays an important role in minimizing financial risks at all stages of saving for retirement. When you spread your investments over various asset classes, you can help protect your investments from poor performing investments because other sectors may be high performing. As you near retirement, you may consider more conservative investments. This example shows a diversified asset allocation portfolio of 50% in stock, 30% in bonds, 10% in commodities, and 10% cash. But it's also important to diversify within the stock and bond allocations. For example, in the stock allocation, diversifying further into different types of stocks such as large, mid, small, or international companies. Keep in mind this does not eliminate risk and there's no guarantee against investment loss. Here are two example portfolios, one aggressive, one conservative. In the aggressive portfolio, 76% of its assets are in the stock market, 20% are in bonds, and 3% other. A conservative portfolio might have 27% in stocks, 65% in bonds, and 8% in other investments like commodities and real estate. Over a 26-year period, these two hypothetical portfolios returned an average of 8.7% for the aggressive portfolio and an average per year of 6.8% for the conservative portfolio. That difference in our example of almost 2% per year can add up over time. You'll notice that the higher return of the aggressive portfolio also came with a higher level of volatility. The largest loss in one particular year was almost 32%, whereas in the conservative profile, the largest loss in one year was a little over 16%. Make sure you are comfortable with this kind of volatility. Upon separation of employment, you are welcome to leave your assets right in your employer's plan. When you retire, you may be approached by financial planners who say that you are required to roll out your employer retirement savings, like your 457 or 403B accounts. In most cases, this is not true. In fact, many people consolidate their investments into their Minnesota Deferred Compensation Plan to take advantage of the fee structure in large plans like MNDCP. And one final point, we often hear from participants who've rolled their accounts over to another plan or to their IRA when they've retired and then realize the fees that they pay aren't nearly as competitive as the fees on their MNDCP account, or they find out their IRA or other plan isn't as flexible. It's important to note that once you roll out all your money from your MNDCP account, we will close your account and you will not be able to roll your money back to MNDCP. Let's take a look at how fees can erode your hard-earned savings. Let's assume you've got a balance of $65,000 in your account. You're no longer making contributions, that on average there's a 5% annual rate of return, and you're withdrawing an average of 4% per year. After 25 years, how do fees affect your account? If you have an account that has a 1% annual fee, after 25 years, you'll end up with slightly less in your account. You've been withdrawing approximately 4%. You've been earning approximately 5%, but the advisor is taking a little over 1%. If you have your funds in MNDCP with an annual fee of 0.1% per year, at the end of 25 years, your account balance would have grown. You're still withdrawing the same 4% and you're still receiving the same 5% annual return, but the fee is less than 1/10 of what you would be paying through an advisor. And if you had no account fee on this hypothetical example, your account would have grown to a little over $79,000 after 25 years. So you can see even a fee that sounds small, like 1%, really adds up over time. It's important to note that the Minnesota Deferred Compensation Plan annual administrative fee is 0.1% or 1/10 of 1% and is only charged on the first $125,000 in your account. When you're deciding about how and when to withdraw from your retirement account, you may want to consider a few things. First of all, your goals, whether you want your savings to last a set number of years, whether you want to leave a certain amount to your heirs, or whether you want to gift any savings you might have to charity. You want to consider the reality, if you will need your savings just to meet your monthly expenses, or if you're going to use your savings for discretionary expenses like vacations, or if you need that money for emergencies or unexpected home repairs. Working with a financial planner to determine how withdrawals from your savings accounts coordinate with those of your spouse's assets, and maybe the most tax efficient strategies you might be using for taking those withdrawals based on your personal financial situation. Keep in mind that employer-sponsored plans such as MNDCP or your 403B plan typically have flexible withdrawal options. Remember, you are not required to withdraw or roll over your account balance once you separate employment. You may take partial withdrawals when needed, for example, for vacations or for home repairs. You can set up a periodic withdrawal schedule, which can be stopped, started, or changed at any time. An example of a periodic payment might be as follows. At retirement, you might decide that you'd like to withdraw $1,000 per month from your account. A few months later, or next year perhaps, you've decided you would like to withdraw less or more. You can request an increase or decrease in that monthly withdrawal amount right over the phone. You can be withdrawing a monthly amount, quarterly amount, or semi-annual amount. And you can take a full lump sum withdrawal of your entire account balance at any time. If you choose this option, you will have to pay state and federal taxes all at once. You may be wondering how long your savings might last. This chart shows an example of a starting balance, a withdrawal amount, and how long it might last once that withdrawal has started. Now, this is for illustrative purposes only, and it assumes a 6% annual rate of return. There are no guarantees of any specific rate of return. If you'd like to do a calculation of what you might expect, you can visit our website and use the calculator called How Long Will My Savings Last? You will enter your approximate account balance at the time of retirement and the amount you expect to withdraw per month. You can also change the amount to see how long that monthly withdrawal would be expected to last into your retirement. Keep in mind these amounts are gross amounts before any federal and state tax withholding. If you have contributions into pre-tax savings, those withdrawals are taxable. There is a 20% mandatory federal withholding unless you set up a monthly withdrawal schedule that's expected to last 10 years or more, or if you're receiving required minimum distribution payments, then you can have less than the 20% mandatory federal withholding. You can also elect to have more than the 20% mandatory federal withholding if that applies to you. Keep in mind, this is not how much tax you will pay at the end of the year, but how much we are required to withhold from distributions out of your Minnesota Deferred Compensation Plan. State tax withholding is optional. If you have Roth savings, those Roth withdrawals are tax-free to you if you have held the Roth account with us for at least 5 years and you take those withdrawals after age 59 and a half. If you satisfy those requirements, those Roth withdrawals come out tax-free because you already paid the tax when you invested the money. When you reach age 72 or when you retire, whichever is later, you are required to take a distribution from your Minnesota Deferred Compensation Plan account every year. The amount you must withdraw each year depends on a formula. If you fail to take a distribution in a particular year, the IRS penalty is 50% of the amount that you should have withdrawn. If you would like, MSRS can calculate for you the amount that is required to be distributed each year. Here is an example of the calculation. We take the balance of your account at the end of the prior calendar year, divide by the factor that corresponds with your age, and the result is the amount that you need to withdraw in that calendar year. If you would like, the required distribution can be set up on an automatic basis, either monthly, quarterly, or annually. It's important to keep your beneficiary designations up to date, whether it's your Minnesota Deferred Compensation Plan, your 403B, your pension plan, your life insurance, or your bank accounts. If something happens to you, your beneficiary will inherit your money in the Minnesota Deferred Compensation Plan, and you can designate anyone you'd like as your beneficiary. You can also designate more than one person, and you can designate secondary or contingent beneficiaries. We'd like to stress the importance of having a designated beneficiary on file. Avoiding probate means your heirs don't have to deal with court in claiming the funds in your MNDCP account. Your heir will receive the funds directly. Actions you can take now include maximizing your contributions or increasing when you're able to afford it. And remember that maximizing your contributions might include lump sum payments of either comp time or unused sick or vacation pay at retirement instead of receiving those payments in cash. Most employees of the state of Minnesota are required to have their lump sums of vacation pay and or severance pay deposited into the healthcare savings plan upon separation of employment per their union contracts. Minimize account fluctuations with a diversified investment strategy, considering a withdrawal plan that's right for you and understanding that you may change that withdrawal plan once you've started it. And keep in mind you're not required to roll out or close your 457 or 403b retirement accounts. You're welcome to leave your funds right in the plan.